The big question in this current pandemic crisis is whether we will see a similar development in relation to NPLs again. So far, the answer is no, but maybe it should better be not yet. The main concern is that as support measures are phased out and the economic shock continues to reverberate across Europe, SMEs and corporate insolvencies are likely to increase and bank customers might find it more difficult to repay their loans. This is likely to lead to a higher share of NPLs on bank balance sheets, and this in turn will require higher provisions, generate losses, and put pressure on banks' lending capacity. In any case, policy and supervisory action to reduce NPLs has been a key priority of the Commission and supervisory authorities since the financial crisis. The new EU regulation on minimum coverage for non-performing exposures, as well as the ECB guidance on expectations for the provisioning of new NPEs, both shall force banks to deal with higher levels of NPLs early on.
The reduction in NPLs took place actually in all member states, including in those where the ratio was very high from the very beginning. So overall, there was a good trend. A trend of NPLs going down has stopped, obviously, and we're now stable at 2.7. But I think we think at least that there's a risk, obviously, of NPLs going up again, especially once the support schemes by member states are phased out. Now, the problem is, when will that be? By how much? We had already a lot of action being taken by the 2017 action plan, as you know, the potential backstop in particular. So we looked at this 2017 action plan and tried to see what were the elements that still needed to be covered and weren't sufficiently covered at the time. And there are really two elements in particular. One is the secondary markets, because we haven't really yet achieved a well-functioning secondary market here in the EU, a really liquid and transparent market. So this was one of the things that we wanted to look into. And the other one is, and I think Thomas, you mentioned that, is the insolvency frameworks. Quickly on the asset management companies, and what we realized is that we had this idea of having a network, and but okay, in order to have a network, you need to have these AMCs first. And the feedback that we had, at least until now, is that there were not so member states, actually, so many member states looking forwards to setting up such an AMC.
In order to avoid a worsening of the NPL situation, I would think it is key to give banks room to support clients. It's very much a bank's own interest to reduce NPLs. It is not that states supervisors need to set an awful lot of incentives, because NPLs, they tie up capital, they tie up attention, management attention, and all sorts of resources.
Putting pressure on banks to dispose NPLs, thus operating on the supply side as a factor leading to the depreciation of the value of impaired asset.
My impression is that the foreclosure proceedings and the varieties we see across Europe, and both Klaus and Concetta mentioned these, this is an issue here. It's also an issue because if I speak to investors, their appetite to invest into NPLs, their countries, and the length of foreclosure proceedings is driving that. I would not expect insolvency rates and hence NPL problems to increase as massively as some observers would expect.
The US market on NPLs and the US way of dealing with NPLs at bank levels and let's say the traditional way how it is done in Europe.
The comparison with the US is difficult because if you look at the provisioning levels in the US that went up sharply, this is very much driven by the credit card business. 60% of total provisioning of US banks, as I said, higher than in Europe, but 60% of that was set against the credit card business that European banks do not have. And that makes the dynamics, because of the structure in the US, so different, makes the dynamics hard to compare. What is clear is what Klaus said, legislative processes, level 1, etc., are much quicker in the US, that results into quicker reaction than in Europe. But that is also driven by a different legal tradition.
Let's say the usefulness of credit investment funds, so loan funds for the effective development of secondary markets. Would this be a viable route? Is this something you think is important?
I think we're pretty, I mean, one of the ideas that we have with our secondary markets is to broaden specifically the investor base, because at the moment what we see is that we have a lot of particular American players on the market, frankly, and we want to broaden that, and you know, we're fine if you know, investors include you know, loan funds as well.
Like publicly funded AMCs, credit investment will be a very usable tool because they could have this medium long-term perspective.
I agree with that. I think private investors, be it asset managers or banks, have much more to contribute to solving NPL issues in Europe than state-backed asset management companies. And the track record, for example, of Greece gives proof to that.
Is there any specific provision or any specific topic or the most important topic or provision in the insolvency laws which needs to be harmonized in order to make progress in this area?
No, frankly, we're looking into this together with the just, but I'm relatively skeptical at the moment that we can. So the only thing that we found up to now was this extrajudicial agreement. On the rest, I think we're very far from harmonizing insolvency laws.